On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to The Money Path. I am your host, Todd Schoenberger, and joining me today is David Waddell. He is the CEO and Chief Investment Strategist for wealth management firm Waddell Associates. David, the headlines are there about the higher highs in the markets. We seem to be hitting a record high every day or every other day. Yet you have this impasse with the continuing resolution. From your perspective, what kind of prolonged impact would this be on earnings expectations as well as the bull rally going into the end of the year?
Well, thanks for having me on. Good to be with you. I don't think the markets really care. And here's why. The most likely outcome of this impasse is that it put more pressure on the Fed to cut rates on October 28th or whenever they meet next, another 25 basis points. And if it extends beyond that, then we get another rate cut in December, which gives you more support for valuations in this market. I don't think from a government fiscal perspective, it's all that important. And here's why. If you dig into the one big, beautiful bill and figure out the timing where we get maximum fiscal thrust up force, it happens next year. I mean, that bill will add 1% probably to US GDP next year. So we may have some employees furloughed, whether they have the constitutional authority to fire people because of this. I don't really know. Mike Johnson came out, said today, I don't think you do, and I don't think we should be firing people. So who knows how this all plays out. It's a Trump negotiation, and it's been a ton of fun in the media business and in the investment business to try and figure out what Trump's going to do. I don't know. Last time we had it, he shut the government down for 35 days and the market went up 11%. So I don't think the market really cares. I think it's getting more attention because we're just in a blackout. We're not getting data releases. We're waiting on earnings season. So we're focused on the sausage making in Washington. But this isn't the last shutdown we're ever going to have. And I think the market's gotten a little bit more resilient in the face of them.
Okay, so that's the overall market. Now let's break it down a little bit, though. Let's say that there is a continuing resolution passage, but the Obamacare subsidies are pulled from it. What kind of an impact or downstream impact would that be on, say, corporate revenues and consumer spending, but on specific sectors such as, say, healthcare and insurance?
Well, healthcare was really underperforming up until the announcement that Trump was going to show Trump RX, which was going to give Pfizer the opportunity to market drugs directly, and the other drug makers will come through. And so maybe they cut out the insurance players, and they get back to most favored nation on drug pricing. I don't really know, but that lifted the healthcare sector. Obviously, the one big beautiful bill had already contemplated the fact that these subsidies would go away. Now they're back in play. If the subsidies end up coming into play again, then I guess that would be net positive for healthcare stocks. But I think that's already been scripted in the one big beautiful bill. So I'm not sure it would really have much of an impact if they just pass a clean bill. And there has been some discussion about the timing of the negotiations. Obviously, the Democrats would like to negotiate this prior to passage. The Republicans have said, but we'll negotiate with you after the passage because it doesn't really expire until the end of the year. Who kind of knows? But I do think the pressure that's been put on healthcare from obviously changes at the top in the healthcare administration, but also from the reductions in healthcare subsidies has been impactful within healthcare stocks. And they got some relief from Trump RX. If they go ahead and pass the clean resolution, then it's probably business as usual there. So might be an opportunity if the Democrats get their way to pick up a pop in healthcare.
So with Trump RX, obviously it benefits Pfizer. Do you see companies like an Eli Lilly breaking into that, or maybe they have already?
I think they have to. I mean, if Pfizer's going to be in that marketplace, you better be in it too. So I really haven't been catching up with the vagaries of each of those individual companies, but that's a new marketplace. And if it's firm and it's going to stand, then they need to be in it as well.
So let's turn the page to the Fed then. So obviously we got the 25 basis point cut, exactly what Wall Street wanted. We received an indication from Chairman Powell that we likely will see more cuts in the final two meetings of the year. But with the shutdown, we're not getting those key data points. And the Fed, as you know, likes to say that they're data dependent. What happens at the next meeting if the government doesn't reopen?
Well, we'll get some of the FOMC minutes, today, I think, to get a little bit better read on body language. But there are private sector, employment reports coming out, and they've come out and sort of reflected the employment market is soft. The labor market's really squirrely right now because we've got a reduction in labor demand from AI and maybe softening economics, although I don't really see that. And then we've got, a reduction in supply because we've closed the border. So we're used to seeing 150,000, job gains a month just to keep unemployment level. And now that number is down to 30 or 40. So you've got optics around it. And I do think companies are saying, let's delay hiring a little bit and let's see what we can squeeze out of this new technology. And I think we're at the early innings of that. So if the Fed is calibrated to cutting rates because the labor market is soft, and the reality is the labor market's not soft, we're just hiring virtual workers instead of actual workers, then it really means that the Fed needs to kind of update their modeling. But rate cuts to support a labor market is good for me as an investor. And I do think that'll happen. And if it doesn't happen, then, Trump goes back to firing everybody and there'll be a new Fed chair early next year. And so these rates are going probably 1% lower from here by mid-year next year, despite what happens with the data, just because that's what Trump wants. And as we noted, Trump sort of gets what he wants.
Yeah, that's for sure. So with that, then, if you're forecasting 1% lower, then I would imagine that would help the 10-year, therefore mortgage rates as well. Are you a buyer at this time in the real estate sector?
I think the real estate sector has got some headwinds in it. I mean, if you look at Schiller year over year, housing prices have come down. There's a lot of supply in the marketplace. We don't get as granular as picking home building stocks, for instance. And although the Fed is cutting rates at the short end, it doesn't necessarily mean they're going down at the long end, although they've petered down some. And I think they've petered down some, not necessarily because of rate cuts, but because people recognize that AI is disinflationary. There was a lot of conversation on the wire yesterday about AI bots being your shopping agents in Chat GPT. I have to go on a trip and I have to go to Scotland. I don't know anything appropriate for that. So I went to Chat GPT and I said, hey, I need to buy some stuff to do this shooting expedition at Scotland. And I said, where's the cheapest place to find it? And it did.
Wow.
The next iteration is that it'll do the shopping itself and send you a bill, right? So that's disinflationary, and it's disinflationary in the workforce. If I'm hiring an AI agent rather than an individual, it's disinflationary out in consumer land if they're doing the, find me the best deal shopping for you. And so I think AI is disinflationary, and I think that's what people underestimate about this. And if you look at longer term inflation expectations, they're kind of trimming down. And so I think that's what's pulling the 10-year, the 30-year down a little bit, is that people are starting to recognize that AI is disinflationary.
That's interesting. I was going to wait to the end of the conversation to start talking about AI, but I'm glad you brought it up. So you have an interesting perspective, though. I love the inflation angle where you're seeing it as a obviously not a prolonged issue with higher inflation, but actually lower inflation because of AI. But the CapEx spend, that's almost like a federal government subsidy right now. I mean, what are your wealth management clients asking you? I mean, are they saying, is now the time to get into these AI companies, or are you waiting for a sell-off or an entry point? I mean, maybe tell the audience.
Well, the question is, what is not an AI company? I was in Silicon Valley not too long ago meeting with some VCs, and I said, what are you all interested in? They said, well, we're not interested in any companies that are not AI native. Like if it's not in your DNA from day one, we're not funding you. So AI has become business oxygen. Everybody's got to have it. Everybody's got to breathe it. I think the natural progression of utilization in the trade goes from the Mag 7s, who are the producers of AI, to the consumers of AI. So if you go from the Mag 7 into the X Mags, the 493, and there is an ETF for that, those are the people that have the big enough budgets to be able to buy the stuff, integrate it into operations, and you'll see profit margins move up. And then it'll start trickling down to the mid cap stocks, and it'll start trickling down into the small cap stocks. But what you'll see ultimately is higher profit margins. So you'll have exponential growth in earnings. You'll have a disinflationary environment, and you'll have a boost to GDP growth, obviously, because the payoff from the CapEx, which is like 50% of all the CapEx in the country right now, gets realized. So I think the chatter around a bubble, is healthy right now because I think people should apply some skepticism to it. But I don't think the AI trade is only sequestered within technology. I think it spreads everywhere. I think it goes into the industrials and the logistics companies. I mean, margin expansion is what this technology is all about. If AI is untrue, you'll see no margin expansion. If AI is true, you will see dramatic margin expansion. I think it's the latter. And in fact, I've been thinking a lot about the exponential impacts of all of this to the point where you'll hear it here first. I'm starting to call it Exponomics because I think that this CapEx cycle will bleed across the entire corporate universe and end up adding more lift than people expect in all corners of the market. For instance, I was doing some research as I was thinking about our conversation this morning. Would have taken me, probably a couple hours to dig into whether we're over levered in the consumer sector and the corporate sector. It took me about 10 minutes, to dig through and ask all the questions I wanted to ask. What can I do with the remainder of that time? Well, I can do my hair, get ready for this. You just get a lot of time back. I mean, AI gives you a lot of time back, and if you're industrious, that means you can do a lot of other things. So I think the expectations on AI actually may be too low, not too high.
Okay. Exponomics. We love exclusives of BTT, so that's awesome. I can see it trending already. So so with AI, the final question for you, and with that type of CapEx spend, your thesis kind of is telling me that because you always hear the baseball analogy as a first inning, second inning, whatever. It seems like the gates to the park haven't even opened yet. I mean, we have this expansion of this sector is truly something that's not just revolutionary, it could change humanity going forward. I mean, am I reaching too much, or what are your thoughts?
All right, let's go there. So I talked to this professor about this recently, and I said, all right, if we can have dexterous robotics and artificial intelligence create virtual workers, and if GDP is nothing more than the combination of workers and productivity, what's the upward limiter on GDP? And he said, we have to think about everything differently. So I think that exponential thinking is the next exercise here. I do think the risk to the CapEx build out for AI is AI itself. Because if AI solves the problem with how to get more for less, lower power generation, sort of the deep seek moment we had back in early February, then that does create some sort of obsolescence risk to this massive CapEx build out. I don't think it's here today, but I do think as AI starts, solving its own problems, sort of that agency effect, that could be a risk. And so if some of these companies come out and say, oops, we invested in $1 billion in the wrong widget and there's a better widget now, then that could create some fits and starts and then ultimately maybe somebody overextends on their budget. So the AI Mag 7 bubble bursts when somebody says we've overextended from a CapEx perspective. And you've seen that a little bit from Bezos. I think he said something about that yesterday. And that's possible. That was sort of the moment that we capitulated back during the internet age, and everybody was like, ooh, Cisco's trading at 225 earnings. That may be too much. So that's possible in the future. But other than the fits and starts, I just think that the benefits of this are profound, and it's really profit margins that you have to watch.
Yes, I do agree with that, and absolutely. And I mean, the trade is going to continue. This isn't just a short term issue. I mean, it's going to continue as far as the sequence going into years to come. So we're anxious to see that. So, David, thank you so much for joining me today on the Money Path. Can't wait to have you back on to continue this conversation. How can the audience reach you?
So the website is wealthstrategists with an s.com. We don't charge and we don't lock up the content. It's all there on the site. So feel free to go in and opt into the weeklies. We put out our musings every week on such things. And, we run money for clients all across the United States of America. And I think about nothing more than how to do it correctly. And that drives me to do a lot of work. And we share our thoughts. So that'd be the best place to get access to them.
Well, that's fantastic and very valuable thoughts. So go to wealthstrategist.com to learn more and read more about what David's thinking for the markets. So David, thank you once again for joining me today on the Money Path. I really do appreciate it, and can't wait to have you back on.
Todd, that was a ball, big conversation, and appreciate it.
Absolutely. So on behalf of David Waddell, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. We'll catch you next time. Take care.